Welcome to the How Did They Do It Real Estate Podcast. Have you ever wondered how people succeed in real estate and what steps they took to get there? If so, this podcast is for you. Your hosts, Sayla and Eileen Prack, interview top experts in the real estate community to share with you their real estate journey and how they achieved massive success. Our goal is to provide you with valuable real estate resources and to help you apply it to your own real estate goal.
Thank you everyone for joining today's episode of the How Did They Do It Real Estate Podcast. I am your host, Sayla Prack. Today we have our special guest, Kim Bays. A little bit about Kim. Kim is a real estate investing expert and founder of Exponential Property Group, a multifamily real estate investment firm that has bought and sold over 9,000 apartment units over the last 10 years. The company has been recognized as one of the 5,000 fastest growing private companies in the US. Kim has been in the real estate industry for more than 10 years and has grown Exponential Property Group from 2 employees to over 170 employees. Before founding Exponential Property Group, Kim was involved in creating and running her family's single-family rental portfolio and house flipping activities. She lives with her husband, Matt, twin sons, James and Nathan, and her stepson, Jed, in South Lake, Texas. Kim, thank you so much for coming on to the podcast today. It's a great honor to have you here. How are you doing today?
Doing great. Thanks so much for the invitation.
So Kim, can you please share a little bit more about your background and how did you get started with real estate?
Sure. So as many people did, read Rich Dad, Poor Dad. I heard it actually was on a radio show, Rangers game I was listening to on the radio, went on rain delay. And so they put on a re-air of a real estate investing radio show that said, read Rich Dad, Poor Dad. So I did. And so that kind of got everything kickstarted. So I joined an investment group, started with some single families, did about 7 of those in the first year. And then took a little time off as my boys were about 6 months old when we started down this road. And so as they got to be a little over a year and were walking around a whole lot more, it was a lot harder to drag them with me to completely beat up disgusting houses. And so took a little bit of time between the single families and multifamily. And then when they were a little bit older and in school a little more, started in the multifamily field. So started with the 77 unit property first and then kind of 1031 and just grew up.
So you mentioned that you started out as a single family home. So what made you make the transitions to the multifamily space?
Well, I think a lot of it is just the scale that you can achieve, but also it is fantastic to have full-time on-site maintenance. That's one of the big things that I did learn with single family is most of the time it doesn't take much work. And so you have a full life anyway, because it normally doesn't take much work. And so then, somebody's dishwasher breaks and it's rather inconvenient in your schedule. And so trying to figure out who's going to go over there and who's going to fix it and what's wrong with it and how to get those things done. So one of the huge blessings of multifamily is having the full-time maintenance so that there is somebody that's on call and available to take care of those things rather than kind of interrupting the life. So it was nice to get to where it was mostly more managerial and vision and accounting side of pieces that I had to do rather than just chasing around to find service techs.
Got it. So you mentioned that you're starting up with the 77 units. And then, so at the time, were you having a property management company managing it for you? Or you said you started in-house as well?
We started with self-management from the very beginning. So had enough experience with the single families, we were able to convince the bank to let us do that. And so it's been a really good kind of growth curve, I guess, from that. So I like that we started from the very beginning. And so there's very, very few pieces of the business that I haven't been involved in at some point or another. So it's kind of a nice thing to kind of understand all of the jobs of all of the different people that are on my team and kind of understand what they're up against on a day-to-day basis.
Wow. So how did you do that? I mean, so you started looking for a multifamily properties and at the same time starting another company with your own property management in-house. Is there any tips that you can provide if somebody wanted to do that as well?
I think definitely do your research. Property management is not for the faint of heart. It's a lot of work, but I think it really does give you the best control over the properties and the process to really be hands-on with it and get to learn the business that way. And so I'm glad that I got to do that.
That's awesome. So you started out with 77 units. So I assume how many employees at the time?
That was just 2, one manager and one maintenance guy. And the manager was definitely kind of more focused on leasing, handled all of the courts for evictions and that sort of piece and kind of the day-to-day property operations. But I was still very heavily involved in kind of the back end, paying bills, making sure all the accounting systems were done correctly and all of those pieces.
Where was the property? Was it in Texas?
It was in Texas. It was in Irving, Texas. So
Got it. Okay. So now that over the years, in the last 10 years, fasting forwards, how did you scale up from there to now? It's like 9,000 units and 170 employees. Can you give us a little bit of the background on that?
Sure. So we 1030 after we sold that first property after about 15 months, kind of got through the pieces that we wanted to get done on that one, and 1031'd into a larger property that was 244 units. And then kind of as we got that one stabilized and we're operating that, added another 444 units. Oh, wow. And so we've kind of continued to churn the portfolio over time. So we've got a little over 3,000 units right now, and one more under contract. We've had as many as about 5,000 units at a single time, but over time have transitioned a lot of properties and really kind of put our stamp on them, fixed up an awful lot of things that had been neglected by prior ownership, and tried to improve management and improve the property in general.
Wow. That is really impressive, Kim. And how do you like this is a lot of deals in such a short time period. How did you find all those deals?
Some of them were off market. A lot of them were fully marketed deals. Sometimes we've been able to build relationships with the sellers that we've bought from. And so sometimes we've gotten to do repeat business with the same seller, which is always makes for a really nice transition when, the contract is more or less done and all you have to do is do a find and replace on the addresses and some unit counts and a few details. Nice to save some time and headaches on the contract negotiation piece. And also just kind of have familiarity with the due diligence process, kind of how we work, how they work. We kind of know what to expect going into it. So that's been nice when we've gotten that opportunity. One of the biggest growth pieces is we had about 4 years ago, we bought a portfolio that was 6 properties. And so that was probably the largest single transaction that we've done. And so that was a very interesting piece, and kind of doubling the size of the company overnight with that transaction was quite the thing. But we got our arms wrapped around it, got all of those properties kind of where we wanted them. And we've recapitalized 3 of them that we're going to hold longer term, and 3 of them we've sold.
That is awesome. So for our listeners, it is investing in with your own monies, or is it some type of a syndication?
This is a syndication. So
got it.
Started out with like only 6 passive investors in the first one. But now that we're doing some larger portfolios, we oftentimes try to have at least 2 or 3 properties in a single investor pool. So sort of a tiny closed-end fund, purchase a couple properties over the course of a few months, sometimes as a portfolio and sometimes that are just one-off pieces that we kind of fit together. But so some of the properties now have like over 200 investors in them. So it is a lot of people. And I'm very fortunate to have an awesome investor services team that takes really good care of our investors and spoils the heck out of them, and probably a little too much sometimes. But that's been really great. It's great to have a team that can really help make sure that all of the questions are answered and everything that the investors need is taken care of.
So for our listeners and as an investor myself, what type of returns that we usually expected, especially from your company?
So we're usually trying to target really a 2x in a 3 to 5 year time frame. So thus far, we've been able to hit that every time, and oftentimes actually exceed it by a decent amount. And so, but that's kind of our primary focus, is really kind of the net worth building piece of it. Sometimes there's some cash flow along the way, sometimes more than others. We've had, one property recently that, based on kind of starting renovations immediately prior to COVID, had dropped occupancy intentionally to get more renovations done, but then kind of COVID hit and a lot of other things and some bad debt in different pieces. And so we actually weren't ever able to make a distribution on that during the time that we owned it, but sold it and were able to return over 100% net of fees to investors inside of 3 years. And so while they were probably a little impatient to get that first check in the mail, they were very, very happy with the checks that they got at the end.
Oh, that is awesome. So you're talking about COVID, there's a lot of things that have been affected by that, including the supply chains and renovation process. How did you guys deal with that? And is there any tips, you can give to our listeners or even a new operators out there?
Sure, absolutely. So when we started with the second property, it was only 50% occupied, and we knew that we were going to need 200,000 square feet of vinyl plank flooring. We were very fortunate to have an investor that was a Chinese national, and so she actually went over with us. We got to meet some vendors, and so we actually started importing some of the things for our properties. And so that kind of has grown into our materials supply and logistics company. So we still do a decent bit of importing, but also have direct distributorships with GE and Frigidaire, Trane. So all of those pieces and kind of having those relationships and all of that ahead of time has really helped. I mean, there were definitely some weeks when we didn't have any refrigerators available, but I think we've been able to mitigate the supply chain better than most. I know that there's a lot of people in the space that as soon as COVID hit, just kind of wanted, put a pause on all renovations and tried to kind of hoard cash. And so with our vertically integrated model, because we had the warehouse full of materials, we have our construction on the interior renovations is done by an in-house crew that are direct employees of ours. And so wanted to make sure that those people still had jobs, and we were able to have them work, only one or two at a unit in small teams. And so we were able to continue executing the business plan all throughout COVID, which was a huge blessing. And I think really kind of accelerated what we were able to do so that our business plan had been executed and was kind of done last year. We did a lot of selling and recapitalization, bought some new things last year, kind of in advance of any potential tax changes was sort of the goal. A lot of those haven't come to fruition yet, but we're happy to have kind of gotten all of those pieces kind of to go full circle and end up where we wanted to be at the end of the year.
That's awesome. So another thing that I probably wanted to pick your brains on this one is that the rise of the interest rate nowadays, as you can see, and we have a lot of concern coming in, in terms of how are you guys going to handle, the purchasing price, and especially like if you want to exit, what is your strategy around that with the interest rate rising?
Sure. I mean, the interest rates rising is inconvenient for all of us. I think the toughest piece on the property that we're purchasing right now is that lenders are a little all over the map in terms of how they're handling it. Obviously, fixed rate is really hard to come by right now. And even if you can get it, it's probably not the best deal because they've sort of underwritten the entire potential yield curve plus a little bit of extra cushion in there. So you're kind of already at worst case scenario a lot of the time on the fixed rate. And so we have been opting to go with some of the floating rate lately. Obviously it makes you a little bit nervous, but there are interest rate caps and things that are in place on it. And just make sure that you really stress test it, that you understand, what your cash flow can be, even as rates rise. Make sure you're stress testing for what can happen with insurance, what can happen with property taxes, because kind of those are the three really big numbers that can impact kind of how the property is performing in general. We've been very, very fortunate in the past. There's probably the two properties that we've owned the longest now of our current portfolio at about a year and a half now. Some of our investors are asking, well, when are we going to sell those? The market's gone up a whole lot. And I was like, we have a 3.5% fixed rate for 5 years on interest only. We're not selling those right now. We can't reinvest at the kind of terms that we've got on that. And so those are good ones that I'm going to hang on to for a little bit longer until we kind of get a lot of the interest rate piece straightened out. I think the surprising piece has been not only is like SOFR going up, but various lenders are kind of all handling it differently. There's a whole gamut. It used to always be that sort of like the spread that they wanted above SOFR was a pretty consistent number for a whole bunch of lenders. And right now it's just all over the map. There's some that are still SOFR plus 250 and others are like, we want SOFR plus 400. And so kind of really navigating that and really weighing the options, because oftentimes those spreads are much, much higher for higher leverage pieces. And so really trying to find the sweet spot of where the rate isn't too high, but you've got enough leverage to execute the business plan that you're wanting to do without being over leveraged. And so some of the lower leverage has actually been sort of a nice thing, and it lets us stress test a little bit better in terms of what could happen.
So in terms of, you're talking about cash flows as well. So do you see a lot of deals that you are looking at nowadays, especially now with a high interest rate? Do you still see the cash flows happening, or what is your observation?
There's definitely some cash flow, but it's pretty thin. It is, I mean, those things are pretty thin, especially in terms of once you underwrite the full yield curve of kind of where the interest rate might end up. They do get relatively thin. We definitely try to mitigate those things by managing other costs, really driving revenue as much as we can. I think that there's been a huge amount of rent increases available to kind of work through the business plan. And so that's been a big benefit too, is a lot of the times we're able to really push rates, push some other income options in order to get enough to offset some of the rising interest rates.
So how did you feel about, like when you do the underwriting? So we're talking about like rent increase, expense increase, and also the exit cap rate. What is your strategy around that? I know it's like some of the market, for example, like Texas, like it's double digits of rent increase in the last year. However, in the underwriting, I don't foresee that, like we're underwriting double digits in rent increase like every year or over year. How did your strategy in terms of like foreseeing the economies or potential recessions coming into the economy?
Sure. I mean, I think Texas is still going to see some pretty good rent increases going forward. There's inflationary pressures, and then there's also just the number of people moving into Texas every day. So housing is a very, very hot commodity down here at the moment. And so I think the rent increase will continue, but I don't underwrite to rent increases that are nearly that large. Oftentimes I can get some really large rent increases. There's a lot of people in this industry that manage very much for occupancy. And so there's times when you can go in and take over a new property, and it's not so much that you're underwriting future rent increases from what it is now, but just that the current market rent is actually hundreds of dollars higher sometimes than what the property is currently charging, because it's been managed to always have, every single unit full except for one, that you're doing a make ready on. And so a lot of the time we can see a lot of NOI growth that's really just getting to current market rather than having to really project huge increases going forward.
Got it.
I like the huge increases going forward being gravy. So, if you kind of figure, hopefully you get a 3% rent increase, and if it's 10, then fantastic, and your numbers get a whole lot better.
Got it. So possibly it's like another question about the exit cap rate. Like the rule of thumbs, they always saying, like add possibly 10 basis points for every year that you hold in the property. And now that, like we thinking about maybe there's a recession, is there any change from your perspective?
I think it's definitely sort of depends on the property location, class, and age of the property to some degree. Definitely underwriting everything with at least a 50 basis point increase over our hold period, sometimes closer to a full percent or a little bit more, kind of depending on the location of the property, the age of the asset, and kind of what else going on with that. So
got it.
Try to be pretty conservative with the exit caps, because those are definitely the pieces that can sneak up and get you at the end.
Yep, definitely. I totally agree. And Kim, what type of properties are your companies investing in?
So historically, we had done kind of a lot of things in the 80s. We still have some 80s properties, and we'll do some of those going forward to the extent that we can find things that are really the perfect fit. But being that I'm about as old as most of those properties, I understand that they start to fall apart around now. So we have been trying to get some newer assets. So a lot of the things that we've been purchasing lately are kind of early 2000s, kind of first generation value add, where they're kind of not quite as beat up and not quite as lived in as some of the older assets, but still have some good opportunities. Oftentimes, early 2000s to mid 2000s were built at a very builder's grade kind of minimalist standard. And so oftentimes there's still a lot that can be done in terms of getting upgrades in there with granite, sometimes refacing the cabinets, adding better flooring options and those sorts of things.
Got it. So, Kim, how individuals, investors looking into invest in real estate can benefit from partnering with a real estate investment firm like yours?
Sure. It's obvious it is a labor-intensive business to manage property. And so I think that's the big thing. I would be very nervous about starting from scratch now. I'm very glad that I got to kind of dip my toe in the water and have a lot of experience and a lot of things just kind of happen and kind of see how things transition and see how things work and kind of refine processes and things while the market has been so hot. I think that's been a really great thing. So I think the big benefit for a passive investor is just that they get to be passive, to be able to get those returns, diversify across some things. Obviously in order to guarantee the loans, I've got some money that has to stay liquid on the sides, but the stock market returns always make me a little bit nervous, even on the stuff that I have. It's, so I think it's a good diversification from typical investments to, and it's something that will do well inflationary times. I feel really comfortable with the Texas market. We've definitely looked at investing in other states, but so far we're just in Dallas, Fort Worth, and Houston here in Texas. I really like just the general growth of the area, business-friendly climate. Obviously, there's some states that could take you 6 months to evict somebody. And so it's very nice that we live in one where if people aren't paying, we can get the unit back quickly and move on to somebody that's going to.
So Kim, if somebody wanted to start up as a business like yours and, like scaling up pretty quickly, is for 10 years, like 9,000 apartment units, is there any tips that you can provide to them to do, like a best practice?
I think some of the things is really just kind of put in front of the other. That's kind of how more or less we built it. Try to go in with a plan, but then be flexible with, adjusting your plan as things go, because there are always things that will happen in this business that are unexpected. And so I think those are kind of the bigger pieces of it is you want to manage your occupancy well, but also push your rents to get your best exit strategy. I think a huge piece of it is to find the right people. Surround yourself with the right people. The on-site teams make such a huge difference. And that's been a piece that we've learned over and over and over again. Sometimes we'll have a property that's struggling for a little while and, you keep trying to play with different pieces and trying to get it kind of worked out. And so, but inevitably we finally get the right manager, or the right maintenance team, or the right team all together, that the whole office team, whole maintenance team really working together. And the second that you hit that kind of synergy, property performance just accelerates and then it's hard for anything to go wrong at that point once you really get the on-site teams figured out.
So, Kim, I mean, as a woman, like coming into this industry, basically it's more like a male-dominated industry, and like the number of women investing in real estate is possibly extremely low. I don't have the statistic, but I think that it's low. So, how can more women get into investing in real estate or get involved in this industry?
I mean, I think it's really an industry. I think there's a lot of people that haven't attempted it, but I don't think there's any reason that they couldn't or shouldn't. I think that's one of the things I've noticed. So we're members of the National Multi-Housing Council, so NMHC. There's an annual meeting we've gone to for about the past 6 years. And I remember the first time I was there, I think women probably were about 1% to 2% of the attendees at the meeting that first year. And it's probably closer to about 10% or so now. But I think the biggest thing that I learned is, to really put yourself out there, go ahead and introduce yourself to people, do the networking, meet everyone else, because in many ways, it's a whole bunch of guys in blue suits and they would rather talk to you than talk to each other, honestly. So if you can find something interesting to say, you can really make some fantastic connections, meet some interesting people, learn, various different perspectives on the business and different metrics. Because as we've kind of grown, recently we had a new acquisitions person join our team last year. And so he came from a much more corporate Invesco Clarion type background. And so it's been really a great game changer for my business because he has different metrics that they considered the most important things. And we have different things. And so we've been able to really kind of learn from one another. I've been able to give him a lot of the smaller pieces that really make the bigger difference on the properties. And he's been able to bring in a very institutional mindset of, what is your year over year NOI growth? What are we projecting? Is that really a realistic projection? It was kind of fun to kind of take that metric and then go back and stress test against all of our historical properties and say, okay, what have we actually achieved? Is this number that we're projecting a reasonable number? And so I think there's a lot that you can learn from people that are in very different roles and backgrounds in the industry if you just take the opportunity to do it.
Yeah. So, Kim, so what is next for you from here?
We're just continuing to build out the Texas Triangle. So continuing to buy in Dallas and Houston, starting to look at Central Texas, Austin, San Antonio markets to the extent that we can find stuff that makes sense. Those are, Austin in particular can be rather challenging at the moment. But, so really building the broker relationships, making sure that we kind of get that opportunity for a last look at a lot of deals, to be able to pick and choose the ones that make the most sense for us. We're also starting to do some ground up development. So we've got our first ground up development project currently in horizontal and should be going vertical, I think September, October timeframe.
Wow, so congratulations on that.
Thanks. It's going to be a new adventure, but we're excited about it.
So Kim, throughout your journeys with the real estate investing, how has real estate investing impacted your life?
Oh, I mean, it's been a huge impact. It's been a huge impact financially, of course, but I think the biggest thing is just it's given me a method through the investors that I have, through the employees that I have, and even through the residents that we have to really, I think, make a positive difference in a whole lot of people's lives. And that's a really cool feeling. I mean, I think even more so than the money, it's nice to just feel like what you're doing is meaningful and making a difference and making other people's lives better. I think that's a huge piece of it. So it's really cool to get to hear investors' stories about, able to send their kids to college with no debt and pay off their house or, retire early or manage to stay retired when they thought that might not be possible long term. So I think that's been a really big piece of it. And obviously the financial rewards have been fantastic. But one of the big things that we're doing with those financial rewards now is we've started a nonprofit. So we're developing a ranch that will be a nonprofit for families impacted by autism. So families can come out and really have kind of a safe environment to do cool things with one another in an area where everybody understands exactly what you're going through. And so a safe place that if your kid cuts in line, nobody's going to yell at you because everybody understands that their kid might be likely to cut in line next. So those kind of pieces, I think making a difference in that way going forward is something that we're really excited about too.
So, Kim, if you have a recommendations to our listeners and trying to get into investing world, what type of recommendation would you give to them, especially for a potential downturn?
I think the thing is really to know your numbers, check things carefully, make sure you're doing a bit of stress testing, figuring out what can happen. You've always got to be a little bit of an optimist in order to just pull the trigger. It's easy to get stuck in analysis paralysis, I'm sure. But so I think that those are the big things, is kind of to watch for what those things are. And then I think the big thing is really to pay attention. And especially if you're going to be sort of the lead investor on a project, make sure that you have the time to dedicate to it, because I think the big thing with the downturn is it's really going to sort out who is paying close attention to the details of their properties versus the ones that aren't. In a perfect market, when everything's going up and everything's happening, well, sure, maybe your returns 80% instead of 100% or 120% or whatever it happens to be, but everything's kind of moving in the right direction. And so I think really kind of watching the details, making sure that your customer service is on point, that you're treating the residents well, that you're taking advantage of the other income opportunities, that you're, kind of inspecting what you expect throughout all of the different pieces of it, making sure that your books are clean and that everything's kind of being taken care of the way that it should, keeping up with the property maintenance, those kind of pieces, I think will really make a huge difference as we get to a bit more of a downturn era. I think that's going to become clear who's paying attention and who's not.
That is awesome. So what tools or techniques have you used to improve the efficiency of your business or your personal life?
So personal life, I'm probably still a disaster. My email inbox is a travesty. But aside from that, as far as business, we definitely have developed a lot, kind of our whole process for renovations and how we manage to do those all efficiently on our materials import side and logistics piece. So for our third party customers and then also for our own properties, we have a single unit kit. So we have kind of everything already figured out in the system. So the manager can just order a kit for an A2 and it will contain all the light switch plate covers you need, how many ceiling fans you need, your faucets, all the rest of it, all in one single large box that can get delivered into the unit, so that you save a ton of time and efficiency in terms of having your guys running back and forth to the shop for things, or even worse yet, running back and forth to Home Depot all day. So I think that's been a huge game changer. Also, we're working on a little bit of software development that will be able to kind of really track just various pieces and automate some of the processes that have been more manual historically.
That is awesome. So Kim, thank you so much for coming on to our podcast today and sharing all your knowledge, especially, like the best practices to run your business, what to look out for is coming soon, like with the potential rate increase, and what are the best practices that all the operators should do or the investors should do. So we really appreciate you coming on to the podcast today. So if our listener wanted to find out more about you and your company, where can they go?
Sure. Our website is www.expppg.com, or you can email and get a hold of our investor services team at invest@expppg.com and can get any questions answered there as well. And even if it's not about investing with us particularly, but just a more general question about some other best practices or things, if you get in touch with them, they can put you in touch with the perfect person in the organization to help.
That is awesome. Thank you so much, Kim, for your time.
All right. Thank you so much for having me on. I appreciate it.
And thank you for listening to our podcast today, brought to you by Bonavest Capital. We would really appreciate it if you can go to iTunes right now and leave a rating and written review. Also, please don't forget to subscribe so you can always get the latest episodes. You can also connect with us on Facebook, How Did They Do It Real Estate. We'd love to hear your feedback and any topics that you're interested in for future episodes. Lastly, to learn more about us, you can go to bonavestcapital.com and fill out the Contact Us page so you can speak to us directly. Nothing on the show should be considered as specific personal advice. Please consult your legal, tax, and real estate professionals for individualized advice.